Hello and welcome. You're watching this edition of All About Your Company. Today we're going to be talking about the lending space and especially the consumer lending space because there seems to be a stronger traction with regard to growth. Bajaj Finance's commentary coming through and them suggesting that there will be stronger traction likely on consumer lending, at least in the current financial year. And we're going to be talking about a new listing on OnEMI Tech. They have just listed themselves in May of 2026. Stock price is up 60%, 65 odd percent since the day of listing. It's up 80% plus since the IPO price, from the IPO price. So we've seen very strong traction on the stock price. We'll take a bit of stock on what this means for the company and the journey going ahead. But this was essentially listed in 2016 for the first time, and or rather incorporated, I beg your pardon, in 2016. Just trying to get a sense of how exactly is it unique. One, it's a Mumbai-based digital lending platform. That's where it's unique. The second piece is that they have a tech-first, consumer lending proprietary AI along with the platform that they run. So it's a little bit of both. One is they have a consumer platform, consumer lending platform, and thereafter they leverage on tech and AI. That's where the differentiator comes in. They own the brand called Kisht, and the market cap of the company is roughly 5,500 crore. When you're looking at, just to try to decode the company a little bit more, they also own an NBFC, which is currently an NBFC partner, but there is going to be 100% ownership going forward with regard to C. Creva Capital Services. And they manage loan disbursements for them, KYC collections and the like. In terms of products, they have, of course, to start off with the loan products that they have. They cater to personal loans and loans against property. That is largely the loan products they have. Of course, as part of that unsecured lending that they do, they also do MSME lending. Non-lending fee products, they have health insurance, auto, savings products, and they license brand and trademark. But more importantly, the other piece that they are going to be starting is also mutual fund distribution, which will be started through a new subsidiary. In terms of tech services that they provide, the Kisht app is the main customer app for borrowing. They have an automated collection system as well in place, and then they have AI underwriting, which we spoke about. It's essentially a proprietary credit decision system, which the AI performs on behalf of the company and the lenders. In terms of the geography and the way in which it is spread, it is currently present in 17,000 postal codes, so very large presence. The AUM mix is tilted towards south and west, where they have a 60 to 65% of the AUM comes from south and west. That's where the tilt is. North, east and central, as you can see, is roughly 38%. So that's the split. In terms of branches, they currently have 101 LAP branches. They're growing LAP fast and they're growing LAP branches fast. What this is doing is it's keeping a lid with regard to OPEX. OPEX efficiency starting to play out, or operating efficiency starting to play out. It's keeping a lid on that. That's where the primary concern lies. Key states of presence: Maharashtra, UP, Uttarakhand, Tamil Nadu, Puducherry, Telangana, Gujarat and Andhra. As you can see, west and south focus, some bit of east as well in that set of states. This is now the city-wise presence. The top 50 cities account for 60% of the AUM. The next 50 is approximately 18% and others are around 22%. So a bulk comes from the top 50, which is the largest. In terms of the loan book, currently at around 8,001 crore, there's off-book lending also that they do. I'll describe that lending in a little bit of how they do their lending. But basically the AUM mix is tilted towards personal loans currently, which is the unsecured side of things. A loan against property is a very small component. Therefore, risk is high. Also, yields are high. As the loan against property segment starts to grow, it will be interesting to see how the yields therefore play out and what plays out on margins thereafter. We'll get some texture from management as we go along. When you're looking at customer cohorts, 53% is self-employed, 47% is salaried, so it's a very decent sort of a mix. The average customer age, now this really stood out, is 32 years. And the average CIBIL score is 746. So that's the tilt. Number of customers, they have 6.9 crore registered users. So there is a decently large size base. Just to give you perspective, HDFC as a group has around 10 crore customers. You've got Paytm with around 40 crore, SBI with around 45 crore. So in that sense, the user base is large. The customers that they've served is around 1.2 crore, and the credit-worthy, the easily tappable customers is around 81 lakhs. So that's really the spread. Let's talk about the lending model now. One is, of course, on book, which they do through their subsidiary, which I spoke about. The other one is off book, which is asset light, right? So they use a lower part of their asset base to lend. So three ways in which they, so loans are booked obviously in the partner's name when it's off book. There are 8+ partners that they currently have a tie-up with. And there are 3 types of arrangements. One is co-lending. Co-lending is where, say, on a 100 rupee loan, 20 rupees is retained by OnEMI, 80 is actually given to the partner. Then there is a direct assignment where the loan is taken up by OnEMI first on its book, say 100 rupees. Thereafter, it is assigned to the partner, say at 105 rupees. And then OnEMI makes the spread on that. Last one is the 100-0 model, where they tap into the customer, check the customer need, thereafter visit the partner, get a quotation from the partner with regard to lending rate and the like, and thereafter retain a fee and pass on the entire loan in the name of the partner. So it doesn't at all enter the books of OnEMI at all, completely enters the books of the partner. Of course, then they provide services to the partner, collections and the like. That can depend, and the fee structure therefore depends on their responsibility. But these are the 3 typical arrangements which OnEMI does its business with. Let's now talk about the financials. And within the financials, first the P&L. You've got a strong growth which has come in around 127% on a YOY basis. You've seen good growth. The pre-provisioning operating profit also has grown at a very healthy clip. Mind you, this may be choppy because it depends on disbursements. These are sometimes consumer loans are short-term loans, and therefore you could see a taper. But largely, we've seen good growth coming through, and the growth guidance going forward is also quite strong. Look at the impairments now. The impairments rose up in FY24, fell in FY25 quite sharply. Thereafter, we've seen a bit of an inch up in FY26. So that's how the impairment picture actually looks. Profit after tax has grown at a solid 216% CAGR. So you've seen a very strong CAGR growth on the profitability of a very, very low base of FY23. So FY23 or just 28 crore of profit, now we're at 281 crore. So you've literally 10x'd in terms of your profit, which is why you're seeing that kind of number. So bear in mind that some of these companies are growing faster because they are also smaller in size. But the growth that OnEMI has guided for is a 40% AUM growth. Let's come to the balance sheet and you'll see that. You've seen, again, very strong growth from 1,270 crore. It's currently sitting at approximately 7,066 crore FY26 AUM. So that's how the AUM has really shaped up. Disbursements also, as you can see, is much larger than the AUM. So there's a payback which the customer makes, and thereafter new loans continue to get disbursed. Because these are short term, you're seeing the disbursements higher than the AUM itself. And the capital adequacy, which is currently sitting at 25.3% at the end of FY26, would have obviously improved by the end of Q1 FY27 because you've got the IPO which has come through, as a result of which the capital buffers have been boosted. So your capital adequacy is above 40% very likely at this point in time. Let's look at operating metrics, and generally this one lends in the region of 29 to 32%. The goal is to keep that 30% plus kind of yield rate according to management. Cost of borrowing, though, you'll see has come off quite sharply. In fact, FY26 cost of borrowing is set to become even better going into FY26, and that is because you've got a credit rating upgrade. So there's a likelihood of a 200 basis point accrual on cost of funds going into FY27. We'll try and understand how it translates. Currently 1:1 on debt to equity on the balance sheet, and therefore we'll see as to how quickly that debt can be replaced by a lower cost debt, and that will likely determine where the margins lie. cost to income, but you can see the very sharp spreads, 16% odd in terms of spreads is extremely healthy. The cost to income currently sitting at 54%. As you can see, FY24 was at 45. So some bit of tailwind between FY23 and 24 on the cost to income side, which got reversed in FY25 because they've launched all of those new branches within the housing finance space and the LAP, the loan against property. So with regard to loan against property, they had to launch those new branches, due to which you've seen the cost to income fall. Let's talk about asset quality now. And the GNPAs have trended between around 2.5% to around 3.5%. You'll see a spike here and there. There was a change in recognition standard, if I understand right, in Q1 FY26. We'll quiz management on that. But there was a change in standard, which is why you saw a spike up in the GNPA per se. There has, at least that's what the management has said on the con call, that there hasn't been too many spikes per se in the GNPA, except in case of change of recognition in terms of number of days past due, etc. So that is the one piece. But the NNPA, that is also been very, very controlled. So they're literally recognizing all of the stress on the book, and that is understandable also because these are consumer loans, short payback periods. Look at the PCR, it's very healthy at this point in time. At the end of Q1 FY27, it's at 84%. Of course, it's been higher at around 92% at one point of time. Let's talk about the ROA picture now, and what you'll see is a steady uptick and some choppiness. You've seen a very strong ROA, of course, FY24, but FY25, 26, it's been between 7 and 5%. Now, mind you, the asset growth will be strong, and therefore ROAs will continue to trend between 4.5% and 5%. That's what the management says. ROEs, that's also a very relevant metric now. Now that you've got that huge equity base coming in, and now that they will start to lever up, we'll try and understand how ROEs will trend. But at this point of time, no concerns with regard to ROAs or ROEs. Shareholding pattern, promoters own 25%. That number is an error. You'll see FI is holding 8, DI is holding 19, and public holding 49%. That is an error from my side. Let's talk about valuations now. The book value currently at 1,343 crore. When you're looking at the profit after tax for Q1, it's at 95 crore. The cumulative book value, therefore, at the end of Q1 is around 1,438 crore. The current market cap is around 5,350 crore. And that's how we extrapolate the valuation price to book current at around 3.7 times. But what this will do is, it will add around 400 crore of PAT at an annualized rate, judging the current Q1 FY27 PAT to the base, which will make or which will shrink the price to book very, very quickly from 3.7 to 3%, to 3 times book, I beg your pardon. So that's the way to probably think of this, that you will see that sharp shrink if asset quality were to hold. But we'll obviously get a sense from the management. And in fact, let me bring the management on board. Ranvir Singh, Chairman, Chief Executive Officer at OnEMI, joining us. Ranvir, great having you. Let me first start off with what's keeping the asset quality strong at this point in time. We've had the West Asia crisis of sorts. What are you seeing in terms of a trend within the consumer lending space? That is one. And second is, what are you seeing on the MSME and the business side of things as well? Any stress or slippage at all? Any concern for you?
Harsh, first of all, thank you for having me in the studio for the show. Let me answer the question. Yeah, thank you. So first, talking about the way we have maintained our credit quality, a couple of points which becomes extremely important. First and foremost, the reason we have been able to maintain high quality is because over the last 6 to 12 months, we have followed a very high degree of prudence. When I say prudence, in the beginning of West Asia crisis happened now, but if you go back perhaps 9 months down, there were discussions of tariffs happening. There are businesses in India which are linked to the global supply chain. They were getting impacted, and there was a second order impact. We took a set of measures only to curb exposure in these linked sectors. Not only that, we also saw some stress building up in few geographies. So as I mentioned in my previous, in our first earning call, that we had stopped lending in 450 pin codes. Now we have opened those lending because we see the things being improving because of the availability of liquidity and some of the stress which we had due to West Asia thing, coming down. So coming to, it's a slew of measures we took, which was primarily around, not getting into zones where our early warning system was flagging things to be slightly more choppy. That was one big thing. The second biggest reason why we have been able to maintain across years and across quarters is at any point in time, we have a sizable share of customers who are repeat customers. These repeat customers come at a lower risk. We have known them. We have had a relationship with them, not only across one loan, but across many, many loans across a time period. And that gives a very different level of conviction when it comes to giving loan to these people and expecting the risk coming out of it. So that's the other thing also which has contributed. For the second thing that I'm talking about, the only reason we are able to do that because we have a large base of customers. In your presentation also, you're laying out 12.25 million customers, of which almost 70% of them are high quality, credit-worthy customers. And these becomes the core or the fulcrum of people who we are able to give loans and then maintain our good quality from a risk standpoint. As far as
how are you able to do? Sorry. Yes, please go ahead. No, please go ahead.
Say no different trend as far as self-employed customers of ours who run small businesses. Very, very similar trend. They are only different than salaried because they have a little bit of a sinusoidal, cash profile, depending upon what business they are in. But almost the same degree of prudence applied in self-employed also has played out in maintaining the risk there.
Right. Ranvir, you're saying that a lot of the customers are repeat customers. How then are you able to lend to them at 30-31% yield? I'm trying to understand if the customer is a good customer, if the risk profile is low, how are you able to lend at the kind of rates that you do?
Harsh, it's a very good question you are asking. First and foremost, what I do for my repeat customer is I do give them pricing rebate, pricing discount. Because these are customers who basically have shown a great track record from a risk standpoint. So it's a risk-based pricing that we follow. So if a new customer comes at 31%, and suppose they have been with us for 4-5 cycles, the same 31 reduces to as low as 24-25 also, and sometimes lower as well. That's one. But the second most important thing, Harsh, here is, I'll tell you, for a shorter tenure loan, one of the most misunderstood thing in the industry is the pricing bit. Now you may say it is 31%, but if you do a math for the ticket size of loan that I give, if you reduce the 31% to say 21% or 24%, maybe reduce it by 7-8%, the absolute impact on the EMI the customer is paying is not even $100. And it is not because of any other phenomena, because these are smaller value loan, and the interest that you are alluding to, the 31% or otherwise, they are basically charged for a shorter period. So suppose if I'm giving a 12-month loan, they are actually charged for 6 months only because it's a reducing balance this thing. So when the customer has to take a call of choosing, say, one loan versus something else, they have to weigh in their mind that should I take this loan where I have to pay 100 rupees more in the EMI versus some other loan where the process is going to be much more long, may not be as straightforward and as dignified as this, and many other submissions of document you'll have to do, etc., etc. And my sense is for the customer that we serve, the swing of the pendulum in choosing which loan to take is usually in favor of convenience. That's why people come to the app and they take loan.
That makes sense. Okay, and what's happening on the cost of borrowing front? Because you're going to see that as a key lever which will play out. Your lending, your yields will largely stay steady state at maybe 30-odd%. But your cost of funds will continue to come down. How quickly are you able to replace your old borrowing with the new one? And what is the impact of that on spreads? NIMs I won't ask because you're now levered up with regard to, or rather you're levered down with regard to that fresh equity issuance which has come.
Absolutely. So just to tell you on the cost of fund, it's a very important parameter to watch out for over next 1 year and further as well. All our new borrowings that we are doing, it is happening at 200 to 250 basis point lower than my existing cost of fund. Part of the reason is twofold. One is, of course, we were rated A minus by CRISIL. And as you know, in Indian market, if you move from triple B to triple B plus, you don't find such a drastic difference in the cost of fund. But the moment you go from triple B plus to A minus, there is a very significant drop because a lot of large institutions open for you. Not only large institutions, your acceptability in NCD paper, the market where you can raise NCDs becomes quite prominent. And the evidence of the data is it was not there in the June number, but it is all there in the public because we issued a 325 crore NCDs and it was very well subscribed. The rate was good 250 basis point lower than what is our current cost of fund is. Now, in terms of how and when it will start playing out in our P&L, it will take some time. It will take around 1.5 years when we realize the full benefit of 200 to 250 basis point, but it has already started showing. The reason it will take 1.5 years, one, of course, the old debt has to retire, but more importantly, at this stage, we are flushed with liquidity, not only because we have got the equity money, but all the profit and the other contribution which has come. It has just made our, and the point that you made, our capital adequacy ratio is already at 40%. So we'll take some time before we draw more debt and basically start realizing the benefit of 200 to 250 basis point reduction that we see.
So by when should that entire 200 to 250 basis point translate on your balance sheet? Will it take a year? Will it take 2 years to replace the existing debt as well as the new debt which you'll continue to add?
What we said emphatically, in the next 9 months, which is between now and March, we will see a reduction of 100 or more than 100 bips. The remaining impact, which will come, will come post March. So good 100 plus bips impact will happen in the next 9 months.
Noted. And Ranvir, I'm trying to understand the growth trajectory. You've done 60% YOY. You've guided for 40%. You've done what I believe late teens in terms of the QOQ growth. So the underlying growth is extremely strong, right? That's at least the trend that I'm making of it. You'll likely exceed the 40% guidance.
Absolutely. That's why we had given the guidance of 40% plus. I mean, a simple maths will tell you in a quarter, if you have grown at 13%, and if you compound 13% over 4 months, the number comes to around 63 odd or so. So the only thing I would say from the growth standpoint is we will well out perform the number on 40% growth. But more importantly, see, it is important to, you may be looking at quarter by quarter data. We actually look at not only quarter, but across many years, we have seen this growth. I think more than just the numbers, I think the point to be made is it's a testament to the offering that we have created. And using this offering, we are able to unearth high quality customers who really value the fact that we are able to approve them in a convenient manner, but more importantly, approve them for the amount and the pricing which may be acceptable to them. And that, if you ask me from that standpoint, the view on the growth is much more positive on going and building business on the back of these customers. Of course, the Q1 is a testament that we will end up doing more than 40% plus by the end of the year.
Okay. And Ranvir, on book versus off book, how do you now manage that mix given the equity now that you have in terms of the buffer? Will you go for more on book? Is there a strategy between on book and off book? What do you keep on book? What do you keep off book?
Yeah, so Harsh, we have followed a very balanced strategy. When I say balanced strategy, for me, the comfortable number is anywhere between 45 to 60% of off book. I don't need to mention it. You have already mentioned it in your presentation. We love off book because it just makes the whole balance sheet asset light. You need to just put a capital which is equivalent to the what is called as first loss default guarantee 5%, and on the back of that, you are able to earn almost the same profit that you make in the on book side. But at the same time, we as good or as great we feel about off book, we also are not a big fan of making a business where off book becomes 80% or 85% and the on book remains 15%, because we are a strong believer that you need to have a stable portfolio split gives a very different level of formidability to the entire balance sheet. So it will be range bound. It will be between 45 to 60%, given that we have got equity. Of course, the equity will be deployed in a manner where the on-book share may increase slightly. Today, as we speak, 54% is off-book and 46% is on-book, and we see a similar ratio to be maintained at least for the next 3 quarters.
Therefore, how long should this equity capital raise last you?
So, given the way we are, we believe for the next 2 years, we'll be in a very comfortable position. Given the higher growth that we are going with, we don't, this capital would be enough and more for us to sustain our high growth over next 2 years. And even then, we will be at a debt equity ratio on the on-book side, well below 3, almost call it less than 2 also, for us to go out in the market and think of a further fundraise as far as equity is concerned.
Give me the commercials for off book. So you make 5%. You mentioned that just in passing. You make 5% of fee on the loan that gets disbursed, and the FLDG, which is first loss guarantee that you give, is also of 5%. Is that how it's structured?
Yeah, absolutely. Let me just explain what I mean by the numbers that I laid out. There is a guarantee I give. It is a risk guarantee. The risk guarantee is first loss default guarantee, which is of 5%, which basically says that contractually, till the time the risk is up to 5%, the risk will be borne by me. If it is more than 5%, it will be borne by the off-book partner. That's the risk arrangement. That's the only capital I need to deploy. But after having deployed that capital, the economics of this business is very similar to on-book. It is absolutely similar. It is equivalent to taking a debt on your book, because the cost of off-book loan is very similar to the cost of fund that we see in our book. Almost similar, erringly similar, I would say. And hence, what I end up making in this loan is whatever I have charged to the customer. Suppose if I have charged 30% to the customer, and my cost of fund that I have agreed with the off-book partner is say 13%. So I end up making 30 minus 13, which is 17% as fee income. But more importantly, I have to I have to do all the servicing, I have to do the acquisition for which I get processing fee, so on and so forth. So everything comes to me as fee income.
Ranvir, the fee is as high as 13%?
The cost of fund. Of course, that's my...
okay.
The cost of fund, that's my... if you look at cost of debt also is very similar to that number. Yeah.
Got it. But what is the fee you charge your co-lending partner, typically, broadly?
So it is anywhere between 2% to 4.5%, 5%. The 2 to 4.5%, 5% is basically the acquisition cost, you can call it. So that's what we end up. There are also partners where it is sub 1% as well.
Got it. Okay. Thank you so much, Ranvir. This has been good. I mean, trying to break this down and understand this, and wishing you all the very best for a very long listed journey in front of you.
Thank you, Harsh. Thank you once again for having me. Truly appreciate the conversation. Thank you.
Very good having you. Pleasure is totally ours. Out of time on this edition, viewers. Stay tuned. More action on the other side.